The UK government provides several tax shields designed to protect your wealth, but using them correctly requires navigating a series of rigid, often invisible, rules. It's a specific trade-off: receive tax relief today while locking money away for decades, or use post-tax income to ensure you can withdraw at any time. Choosing the wrong account can lead to significant losses through inflation erosion or unnecessary payments to HMRC. This math is shifting. Starting April 2027, new legislative reforms are scheduled to change how conservative cash savings are treated, specifically targeting those who hold large balances without investing them. These changes mean that the traditional strategy of simply holding cash is becoming a less effective way to preserve long-term wealth. To navigate this, we need to map out which tax wrappers are appropriate for you, based on your income and your immediate goals. Understanding how these accounts interact is a necessary step to ensure your money is working as efficiently as possible over the long term. The foundational baseline for most UK investors is the Stocks and Shares ISA. You can contribute up to £20,000 each year. It is funded with post-tax income, meaning you've already paid income tax on the money before it enters the account. As this matrix shows, the primary benefit is that your investments are exempt from capital gains and dividend taxes for as long as they stay in the account. You also don't have to report these gains in a tax return. For those between 18 and 39, there's a specialized version called the Lifetime ISA. It has a £4,000 annual limit, part of your overall allowance. The government adds a 25% bonus to your contributions, providing up to £1,000 extra every year. There are strict conditions. You can only withdraw without penalty for a first home or after age 60. Taking money out for any other reason triggers a 25% penalty on the entire balance. Because this hits your deposit and the bonus, you lose money. Using a LISA requires you to intentionally trade immediate access to your cash for increased purchasing power when buying a home. Many savers have historically preferred the simplicity of a cash ISA to avoid market risk. But the upcoming 2027 reforms include plans to cap the amount of surplus cash you can hold in certain tax-advantaged accounts at £12,000. Along with that cap, the government intends to introduce a 22% tax charge on interest earned from cash held within investment ISAs. This effectively reduces the yield of safe cash balances significantly. To maintain the tax efficiency of your savings, you may need to move balances that exceed these new limits into market-based investments. These policy shifts show the government encouraging savers to move away from POSH and towards the stock market, protecting capital from taxes and inflation. If you are in a higher tax bracket, the most powerful tool available is the Self-Invested Personal Pension, or SIPP. SIPPs use a pre-tax model and allow for contributions of up to £60,000 per year. Look at the matrix. The government provides a top-up matching your highest income tax rate, offering significant upfront relief. The catch is the total loss of access. SIPP funds are locked away until age 55, a limit increasing to 57 in 2028. There are rules for eventual withdrawals. Usually only the first 25% is tax-free, with the remaining balance taxed as regular income during your retirement. Choosing a SIPP is a decision to trade decades of liquidity in exchange for significantly reducing your tax bill today. If you are able to maximize both your £60,000 SIPP and £20,000 ISA limits, you'll need another place for the excess. This is where a general investment account, or GIA, comes in. Unlike other accounts, a GIA has no built-in tax shield. Your gains face capital gains tax once they exceed the current £3,000 annual allowance. To manage this, many use a process called bed and ISA. This involves selling just enough of your investments each year to stay within your £3,000 tax-free allowance, then moving that cash into your protected Stocks and Shares ISA. While effective, using a GIA requires careful record-keeping and active management to stay within these tax limits. Now we can map these tools to your specific financial goals. If you are saving for your first home, the LISA is generally the priority for the state bonus, followed by the Stocks and Shares ISA for any remaining savings. At this stage, access to your money for a house deposit is more important than pension tax relief. But if your goal is long-term retirement planning, the priority usually shifts. In this scenario, you would prioritize the SIPP to maximize tax relief, then fill your ISA. The GIA is only used once those tax-advantaged limits are reached. This strategy focuses on reducing your tax burden, but if you rely on cash for security, upcoming legislative changes suggest reconsidering your approach. Relying on premium bonds or large cash ISA balances after 2027 could lead to higher taxes and the gradual erosion of your money's value. Choosing the right combination of these accounts changes the long-term projection of your savings. The UK's tax system is structured to reward those who take an active role in planning their finances. Your next step is to select accounts that align with your goals and automate your contributions. Understanding how these wrappers work is how you ensure the tax code supports your financial growth rather than hindering it.